Well, it's 3 days in a row to the upside now. I almost did want to come back. Brandon, it seemed like every day Brandon does a video, the markets go up, and so, 3 in a row. But fortunately for all of us, the market continued higher today, even with me doing the market outlook video. I'm glad to be back after a little time off. I'm going to break down the new posture. How bullish are we right now? Are we bullish across the board? Is this the start of intermediate run number 2? I'm going to break that down, as well as a trade idea for a stock trade in a hot sector right now. So let's go ahead and get started. Today is Monday, July the 9th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thanks for tuning in, especially those that are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by mousing over the logo, the Market Scholars logo in the bottom right corner of the video, and click that red subscribe button that pops out there. Also, click on the thumbs up icon down below the video. That tells me 2 things. Number 1, that you liked our video today. Number 2, you want us to keep doing this day after day. Join our our daily Market Outlook email list. There's a link popping out in the top right corner of your screen up there. Click on that link. That will take you there. Also, follow on Twitter for more content like this throughout the day. And join our Market Outlook community on Facebook. All right, well, let's start off taking a look at the S&P 500 here. 3rd day in a row of gains. In fact, we're going on, 5 out of 7 up days coming off that low point here. At the end of June 27th, when the intermediate line finally crossed below the 50th percentile. That ended up being the lowest low point on that day. And then, of course, we've since rallied. The intermediate line has come back up above 50, which is what we expected. Right, we've talked about this. We talked about that a market sentiment run, like we're currently starting here, consists of multiple intermediate rallies. This was one. And now we're heading for another one. We expect it to be 1 to 3 months. Doesn't have to be 3 months. Probably will be more closer to 1.5 as market sentiment line gets higher. And we've also talked about the possibility that we'll just have more volatile runs. It won't be as low volatility as we saw in 2017. But regardless, we expect to move up, up to high. We're coming up off a higher intermediate low point. This low point here at the 50% Fibonacci retracement level is higher, obviously, than the last one, which is here. The last time the intermediate line was below 50. And so we expect a new intermediate high point. Here's the intermediate high point that we hit at resistance. We expect a new one to come up above it, probably head up towards that resistance level, around 28.75. Which is almost 100 points away. So, and again, in like a market sentiment run, the orange line, like that consists of multiple intermediate rallies, which is the intermediate line getting above 50 and then finishing when it crosses back below 50. The intermediate rally consists of multiple near-term runs. So this one, this intermediate rally had this first near-term rally. Then we had a couple, short bursts up and down, up and down. And then we had a second intermediate rally or near-term rally right there. And then finally a third near-term rally that petered out and we ended up turning bearish. So it ended up with basically 2 strong near-term rallies with a couple small brief ones here, sideways action here in the middle. So here we are, number 1, near-term rally number 1. The intermediate line has been above 50 now 3 days. We expect it to be above 50 for 7 to 12 days. It's been above 80 now to really solidify that run for 2 days. So 2 out of the 3 days we've been above 80. Out of the 3 days that we've been in the upper half of the chart. So pretty solid. I mean, Friday's close. We broke above all those highs there, broke above the 6-week moving average. Today's solidifying that with another high and closing above these highs over here. It's still not quite up to new highs yet, but it's making its way there. And so, again, we've expected a pullback, an intermediate pullback, and we expected a bounce up to new higher highs, and it looks like we may be headed towards that. Of course, anything can happen. We could turn right back down tomorrow for all we know. We wouldn't expect that, right? We'd expect that we continue higher, but anything can happen, right? So just because things don't happen as you expect doesn't mean that your expectations were wrong. It just means that something came out in the markets and the news or whatever the markets didn't know about. Otherwise, they would have already priced it in, that they're now starting to price in. And And that's what happened. That's why we put stop orders on trades. That's why we manage risk. Otherwise, if everything worked out according to our correct expectations, then we just make money. It's just a matter of being right all the time. We just make money all the time. But that's not the reality, because it's the market run by humans, and humans obviously have emotions and everything else that goes along with that. So you look at the Dow Jones Industrial Average, and you can see, it's been lagging. Its intermediate line has turned up finally. This low point here was only slightly higher than the last intermediate low point, so did not hold Fibonacci retracement. In fact, came down a little bit below the 62% Fibonacci retracement line. You can see there kind of hitting the 78% Fibonacci retracement, right around 24,000. But nonetheless, bouncing back up. Its near-term line getting into the reversal zone. So positive from that development. You're getting out of the reversal zone. The intermediate line doesn't usually stay down there for very long. So bullish nonetheless, just not as bullish, of course. The Russell and the NASDAQ composite would include those big 100 companies in the NASDAQ in QQQ, but also includes a lot of small cap stocks. So it looks very similar to what's going on in the Russell 2000. Both very strong short-term sentiment. It's about as high as you can get. The Russell 2000 is almost at all-time highs again, where we got those 4 clusters in a row. I mean, look at the 1-year return for the Russell's 20%. We're at a 12.5% 3-month return. So pretty decent returns for risk appetite, for considering how bearish a lot of people have been. It's kind of hard to be too bearish when those are the numbers you're getting, which means that a lot of people, the more bearish people tend to be, I've noticed, and this is just obviously anecdotal, so take it for what it's worth, but generally people that are the most bearish are people that missed this, that want to get something like that and want it to come back down so they can get in the low point. The problem is, as it does come down, then they talk about how they were right, how they, this is the bearish move they were always expecting, and they never take advantage of it and actually buy in at those lows and then miss out on the bounces, as we see. So happens a lot. It's hard to be too bearish when you see those kind of numbers on year, 3 months, 6 month, and 1 year returns there, and continuing to move higher. Intermediate posture bullish. Same thing with the NASDAQ composite, almost all-time highs again, just like on the Russell. Just a reminder again before we look at these other charts that if you're watching this on our Market Scholars blog, first of all, if you're not watching on the blog, you can get there by clicking the link that's popping out in the top right corner of your screen there. That will take you to our blog. And then as you see the post here, what we ask for is 3 clicks. One is to like here on Twitter, if you have a Twitter account. 2 is to click here if you have a Facebook account, to click there to like it on Facebook. And then 3 is to click this like button right down below. Those 3 clicks are feedback that we're looking for to see whether or not you think today's video is valuable and whether we should keep doing them. So while you're watching the video, just scroll down below, click on those links. We really appreciate that. You'll also notice down here is a form to fill in if you want to join our daily market outlook email. You can share this blog post on Facebook, Twitter, or LinkedIn, or through email with any of these buttons down here. 28. Let's see if we can get a higher number than 28 on our next one. And again, you can retweet, you can share it on Facebook, all those things, all from right here. Here's some of our more popular posts that we've had on our blog here lately. Of course, you can connect with me there's my profile here on the marketscholars.com, and here's some upcoming classes. If you haven't subscribed to our site yet, you can do that right up here in the top right corner. So back to the charts with Friday's move. We got back up above a rising 50-day moving average. We're still above a rising 50-day moving average. So again, from a long-term standpoint, the green shading means the 50 is above the 200. That's not all you can look for, right? I mean, you're more bullish if you're above both a rising 50-day and rising 200-day moving average, and the gap between the two is rising. So we have all those things right now from a long-term basis. We have the dark green shading on the market forecast as well, with the intermediate line getting above 50. We expect that for another 1 to 3 months, right? Probably closer to 1 to 2 months, considering this is now our second intermediate rally on this long-term run. But you look at the long-term chart, and again, it's green too, which is great. But then you look, dive into it, and it's looking good. We're above all those, both those rising lines. Now we look at the 3 green arrow chart, and we see, okay, it's shaded green as well because we got 3 green arrows. We're above a rising 6-week moving average. MACD is green, stochastic's green. You look at the 2-line versions of those 2 indicators down there. The MACD is crossing above 0, stochastic's crossing above 50. The 8 and the 17-day now close to crossing above the 30, with price already above the 30. Again, you can't, those are all the things you look for in these charts, and we basically have a technical setup to be about as bullish as you can be from both a long-term and an intermediate standpoint, the intermediate perspective given by the market forecast chart, as well as this 3 green arrow chart. All right, so the final check then is to look at the short-term chart, and you can see, we are above the chart's midpoint. We did that on Friday again. We're closing, solidifying that today, closing above these highs, which would be the 23% Fibonacci retracement of the high to low. In fact, we actually need to delete that drawing, remove this drawing, and we will throw on now the Fibonacci retracements. Excuse me, let's do the open, high, low, close here. We'll throw on the Fibonacci retracements now from this high point down to the low point right there. So, and then throw on the 23% Fibonacci retracement level. There's that 78% as well. So yeah, closing up above that 23, 78% Fibonacci retracement. So, making its way up strongly into kind of that upper quartile of the 4-week range. Very strong position, bullish position there. And then again, obviously not getting new 4-week highs. That would be the strongest, but still pretty decent move. And we'd expect that eventually we'll start pushing that up to the upside and getting new 4-week high points again. From a volatility standpoint, you can see, we are coming down to what would be a lower low point on volatility. That's your last high. It was a lower high. We broke through 15 on Friday, and now we're even further down, getting back down to strong, bullish levels. Not extreme, as you notice, we're at the 85% mark here of VIX relative to VXV. So, when we get below 80, that's when it gets extreme and you expect a bounce in volatility. We're right in the bullish sweet spot right now. So it doesn't mean the volatility is going to go down. In fact, I'd highly doubt it goes down too far. But there is, the possibility that we'll stay down here for a while and the markets will stay bullish during this intermediate run that we're expecting, again, that we're just starting and that we're expecting to last one to probably 2 months. Typically 1 to 3 months, but probably more towards 1.5, 2 months time frame on this current run. And remember, of course, too, we still got that seasonality aspect that also typically we have low volatility until July expiration, which is actually only a week away. So we'll see how much bullishness we get heading into July expiration, and then how much we get after that, which isn't typically a whole lot. So what do you think about today's market posture? There's a poll popping up in the top right corner. Do you agree with this bullish move that we're starting here or not? Do you disagree? Click on disagree if that's the case. If that's the case, scroll down to the bottom and let me know in the comment section. What are you seeing that makes you less bullish than what we've determined here from our market posture routine across these multiple time frames? When you look at what's driving the market action today, you can see on the calendar it was more about what wasn't driving the price action. Like there wasn't anything negative about these trade war rumors, or now not rumors because it started here at the end of the week. But the fact that there wasn't anything that came out in response per se, the market just kind of rallied and took a breath, and everything that was the worst performers outperformed. You'll see here in just a second. We take a look at the economic surprise index. You can see how it's really starting to shape up and look a lot better globally and bouncing up higher here, and that has a lot to do with things. In fact, even in the U.S., we've had lower GDP estimates, but still 3.8%. It's a little bit lower than where we started out from, so we've pulled back. Still around the consensus, here, so kind of in the middle of that range. That's still a strong number compared to what we've seen. And of course, the rate hike odds have jumped back up now to get that fourth 2018 rate hike in December. And you can see it's up to 56, over 56% odds that we'll get, a rate hike first in September. So the next one in September. So we're up to 85% odds practically. And then, of course, the last one for the year would be in December, which now we're, like I said, almost to that 60% mark. It's kind of where we say, there's a higher probability of that happening. So, things are look from a broad economic standpoint. Things are looking good here and looking better globally, and we're seeing that reflected in a lot of things improving today. In fact, you can see the biggest winners were these Asian markets. Russia's up there too, but China, which has been a big laggard, you can see India, Russia, China, all these major, among the 12 biggest economies, which is what this shows, those are the biggest emerging markets. You can also lump South Korea in there as well. And of course, you see emerging markets just taking off. And developed markets kind of matching the U.S. Large cap stocks benefiting too, more so than small caps, even though, like I said, small caps are already almost close to all-time highs again. On the other end of the spectrum, the dollar underperforming, gold outperforming the dollar. Crude oil was lagging early, ended up outperforming gold by the end of the day. So risk on move there. And of course, long-term bonds falling, which means yields are rising. And that's a positive development for risk appetite. High yield really outpacing long-term bonds there. So when you look at the foreign markets here on this chart, so we'll take a look at it right here. Again, China, Russia, and India. So here's India. You can see the move. It's making kind of a breakout move today. Same thing with China. Coming up off these sharp lows. In fact, everything. There's Japan coming up off of sharp lows. Russia breaking up to new highs. Very strong move for Russia there. So it's got a strong intermediate posture. China and Japan are still bearish, and India is rising here. You can see Korea is also still bearish too. So those three have been so beaten up. They're just now starting to show some gains. On the other hand, you can see some improvement in all these developed markets. France, UK, Germany, Brazil finally starting to show a bullish posture, about as weak as you can get it. Same thing with the UK, but still, bullish, showing bullish again. And of course, Canada benefiting from these trade wars as well. You expect Canada and Australia to be kind of beneficiaries from any kind of trade tariffs or trade disagreements that you might have with between the U.S. and China. The other risk-on component of today's move occurred in the sector rotation. You can see financials, which has been the most beaten up sector, finally rallying. Industrials as well, it's far below the moving average as those two were, finally getting up above it here. Materials also making its way. So those three sectors are the ones that have the lowest intermediate posture. You notice all the intermediate postures for all the sectors are bullish right now, but those three are the ones that are just lagging and coming up. Big moves to the downside, especially in utilities. They also have the strongest intermediate posture to the upside. So they're pulling back, and there's a rotation out of the strong sectors, which are the safe haven areas, into the more beaten up areas. And of course, these are the 5 sectors that all outpace the broad market today. These two in particular have industrials and materials have been the losers from the trade wars, and then of course financials also lagging because of the yield curve flattening. On the other hand, you can see discretionary technology, those and energy, they have been previous leaders, both now, all three of them getting up above the moving averages. Healthcare getting up to new 3-month highs, now up 7.4% for the 3 months. In fact, you've got double-digit returns for these previous leaders here over the last 3 months. You've got healthcare doing pretty well too, at 7.4%, and telecom also getting up to new 3-month highs. And these three, are really lagging behind, so they've got some room to catch up. And these three over here, the safe haven areas, didn't have a whole lot of gains to give back. Staples is just coming up off of some severe low points. So it's kind of slowly trending its way up. Still negative 3-month return. And utilities is the one that had made a big bounce up higher and a big strong move in June, and pulling back a lot of that move all in one day today, kind of hitting, moving down and hitting old high points here, as well as Fibonacci support. All right, one stock in that healthcare area that's showing some really good technical breakout patterns is Perrigo. It's a over-the-counter generic pharmaceutical company. You notice its intermediate line breaking up in the upper half of the chart, coming up off of a phantom green arrow, so to speak, breaking up to new high. So this would be a new intermediate high point. In fact, here's the last intermediate high point we just had. Before that one, the last one was way up here. So we've got a long ways to go now, and you can see it's been basing and looking like it's starting to break out. The market sentiment lines rising up above 20 now. If you take a look at the some of these other indicators, let's look at the 3 green arrows. You see we got 3 green arrows on it. Whoops, let's go to Perrigo. One second here. PRGO. You can see we have 3 green arrows, and we had a spike in volume today, 1.5 times the average volume. You take a look at some of these other technical indicators that we look at on occasion, like the Bollinger Bands. You can see we're closing up above the upper Bollinger Band with a low bandwidth. That's always a positive breakout type signal. You can see the DMI. If you take a look at the DMI, breaking up above, the ADX is above 20, and we're breaking the positive lines, crossing above the negative and above 25 at the same time. So positive development there. So positive signs, you can see, the one, really that you don't have per se is, the long-term chart. We are back above the 50-day moving average, and it's rising. And the gap between the 50 and 200-day moving average is shrinking again, just barely. So you really need to get above that 200-day moving average and take this off again before you be too bullish. But you can see we're basing, and it's trying to figure out whether it should take off again. Last time it made a run from 60, 63 all the way up to 100, close to 100, about 95, 94. So we'll see if we come off this 70 level and make another run up towards that area as well. Considering all these technicals. So today's idea would be just to buy the stock and put your stop order below the low point that preceded this 3 green arrow signal. So we'll go back to PRGO here. There we go. So this low point right here, putting in the low there is at 71.72. So you put your stop order 1 ATR below that. And there's your 3 green arrows. So if we pull back down like others have, we looked at Hog in the past, and it's pulled back down, but didn't get down to its old, below that low point, and it's starting to close in this tariff. When it had the tariff news, really sold it off, but it still held that low that we bought off of here with that 3 green arrow signal, and now we're getting a potential new 3 green arrow signal as it starts to make a run up higher again. So that's why we put our stop orders below an ATR below that low point. So if we do pull back, it's okay as long as it doesn't go past that and form to either an equal or higher low point and continues to trend higher with these technical patterns that we've been looking at. So what do you think about today's trade idea? What do you think about today's market posture? There's a link popping out that takes you to our market outlook forums on marketscholars.com. Click on that link and let's talk about what we talked about today in the video. Let me hear your comments. Make sure you tag me at SettleDA. That's my username on marketscholars.com. That way I can see your posts there. Remember, you have to subscribe to our site to participate in our forums. You can do that for free. There's a link I showed you earlier on the blog. Thank you very, very much for watching tonight. We appreciate you spending your time with us day in and day out. Remember to subscribe to our YouTube channel if you haven't already. Like today's video by clicking that thumbs up icon. Comment on anything that stands out to you. Follow on Twitter for more content like this, and join our Market Outlook community on Facebook. Thanks again. Have a great evening, everybody, and we'll see you all next time.